Good Friday morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show. Before we get started, please take a look at the screen and read the disclaimer. Just so you know, Market Chameleon, myself, or Dimitri, none of us are registered investment advisors or broker dealer. If you need investment advice, please reach out to a broker dealer and read the disclaimer. There it is. With that, D, do you want to get started?
Yep. Good morning, everyone. I'm going to share my screen. And if you guys are joining us for the first time, welcome. Will and I, we do these shows in the morning to try to help answer questions you may have about the Market Chameleon tools, the data, or the analytics. If you have a question, put it into the live chat on YouTube. Will's watching that, and he'll read back those questions to me. We're going to take a couple minutes to give you a chance to put those questions in, and we're going to cover the pre-market report, see if we could get insights, what's going on in pre-market hours, and then we'll move on to the questions. So pre-market report here, these are stocks trading in pre-market hours. Up top here, we see this calendar view, and this gives us the summary statistics, what happened in the pre-market hours on those historical dates. And it's really there just to see if you could eyeball anything unusual or a trend. If you click on that date, it'll take you to the historical date, and you could see in more details what happened in the pre-market hours. Today, we're on March 15th here, and so far we have 455 stocks trading higher in the pre-market, 333 stocks trading lower. We have 162 million shares trading on up volume, 83 million shares of stock trading on down volume. If we convert that volume to dollar value, we have $1.2 billion worth of stock trading higher, $3.6 billion worth of stocks trading lower. So that kind of gives us a mixed signals here. More the stocks trading higher exceed the stocks trading lower. The dollar value of the stocks trading lower exceed the dollar value of stocks trading higher. So, nothing conclusive there. I would say kind of a mixed bag. Let's look at it from a couple more perspectives. Then we'll move on to the questions. I'm going to scroll down. And now we get to see a list of stock symbols trading in the pre-market hours with the price changes, volume, and market cap, any type of alert. We have a list of our most active stocks, our biggest percentage gainers and biggest percentage decliners. And here we could see that 42 stocks made our biggest percentage gainers list, 53 made our biggest percentage decliners list. So that points to a slightly bearish lean in the pre-market trading. Now, to make this list, we do set thresholds in place because stocks trading in pre-market can have very low volume, low liquidity. So we put thresholds in place before it can make it onto this list. However, if it meets those thresholds, it could be any stock. It could be a small cap stock. So we see here market cap. A lot of these are small cap stocks. It could be an ETF. It could be a leverage product. It could even be an inverse ETF. So to narrow down this list to a small group of stocks, we could use the filters up above this. If you do have a watch list and you track a certain group of stocks and you want to filter this list by your watch list, you can do that. We're going to use this filter in our example, an ETF. I'm going to click on it. We get a drop-down menu to select from different ETFs. I'm going to choose this one, SPY. And when we do that, the list below gets filtered by stocks that are holdings in the SPY. So here, which are the S&P 500 constituents. Right here, we got 5 stocks that made our percentage gainers list, 11 on our decliners, and that points to a slightly bearish lean or bearish sentiment in pre-market trading. So nothing like incredibly overwhelming to one side or the other so far. A couple mixed signals, maybe slightly bearish so far. But we gave it a couple minutes, so if we have questions, I'll take them now.
Nothing's popping up yet, D.
Okay. Let me go to let's go to QQQ. We'll default today to QQQ, and let's just see what let's look at the multi-leg trades from yesterday in QQQ. So I'm going to go here under options, and we're going to look at these multi-leg trades. And what this does is it looks at yesterday's options trades that were multi-legs. The software groups them together, makes interpretations, what is the most likely strategy there, and creates this report. So this is for yesterday, right? We're not open today yet. As of yesterday, if we click on here, we see all the different strategies that we detected on QQQ yesterday. So these are all of them up here. You could see that there are 609,051 contracts involved yesterday that were part of more multi-leg trades. And there is 6,639 different unique combinations of spreads. Okay. Top one are put spreads. You could see 231,000 contracts were involved with put spreads, 104,000 with call spreads, and so forth. And over here, next to it, this 1,505, what this is saying is that there are lots of different combinations of put spreads, right? Because a put spread could be different expiration, it could be different strikes. So if they're different, they're unique from each other, and there's 1,505 different unique combinations, right? So if you click on it over here, so right now it's set to all, so we see the most. This is sorted by the most volume. So this top one traded right at near the end of the day from 351.47 to 401.45. This spread traded multiple times, 47 times. April 12th, 395, 420 put spread. Right, so this goes out. This has 29 days to expiration, and it's a $25 spread. And what this is saying here, and this was detected as potentially new position. So let's take a look at that one actually first. Let me close this. So we're going to open up the details here. And you could see that the last bid and offer was 190, 198. So the VWAP price was 203, right? So this was traded at $2.03 VWAP price with bid 198, 203. So it looks like somebody perhaps was, buying this spread from the dealers. That's the initial assumption just looking at this data. So we could dig deeper in here. I'm going to click on this open. So this is what happened yesterday. And as you go down, you're going to get more details of the spread. So here's all the times that it's traded with the volume and so forth. If you click on this, these are the actual time in sales. But here, what this is telling us is that in the morning yesterday, the open interest on the April 395 put was 189. And on the April 420 put, the open interest was 1,259. Now today, which is the next day, right, in the morning, this is the new open interest, 24,788, 26,159. So you could see that the open interest increased on both of these options. So this is the volume in each leg, right? 24,653. So you can see that the open interest increase, and there might have been other trades in there, but essentially it increased by the amount of this spread. So it looks like that this spread that traded yesterday, was a new position, right? Because the open interest increased significantly. That would be in line with the volume of this spread. And so far, unless they close out today, it still exists on the books, on the, in somebody's inventory. So that's kind of one takeaway we could do in the morning. All right, that okay, this spread traded at the end of the day. Now it's sitting there for $2.03. Right, it's got 29 days left to expiration. April 12th it expires, and we could see here that the strikes are $25 apart. And this is an out of the money put spread, right? Because stock's 438.37 when this traded. This is 395, 420 put spread. So that's really quickly just kind of going over yesterday's spread and seeing, from the perspective of, this was the biggest spread yesterday, or the biggest volume in a spread yesterday in QQQ. This is how it traded. So you could see 47 different times, kind of close together, right? Starting at 351.47, you could see 1,112, 690, 150. So these are the volumes, and it looks like it's going to different exchanges. And really, to me, it looks like it's trading, sometimes even right through. So to me, it looks like, that it's going to different exchanges and trying to buy it from the dealer. Right. So that's how it looks like to me, from multiple dealers, because it's hitting multiple exchanges. Okay.
We did have a question from Rob.
Yeah.
Sorry about that. Rob was asking relative to as I recall, the old calculator showed the win weight from the trading cards. Does the new one show this as well? I couldn't find it. If D can spend a second, maybe you could go through that.
Yeah. So we could set this one up, right? The April 12th, 395, 420 put spread. Let's do that. So just keep in mind, April 12th, 395, 420. So I am looking at April 12th expiration. So this is from the options chain. And I think it was, here we go, 420.
395, I think you said.
Yeah. So I went down April 12th, a QQQ expiration. I went to the 420 put. So here's the 420 put, the offer. So I clicked on it. It gives me the April 12th 420 put over here. And then I think it was a 395 put was the other leg of it. So I'm going to find the 395 put, click on the bid. So here are the two legs. Buying, you could flip it, but we're going to do this side, April 420 put, buying one, selling April 395 put, ratio 1-to-1. So let's run this analysis. And now we have a summary stats over here. Okay. And it's showing us this is the market, as of the last snapshot we have. With the midpoint, we're talking about that spread. It's important whenever you're trading to pay attention to the spread. And we talked about this yesterday, how wide the spread is. Then we have over here the two baseline theoretical values, right? So the what this is for is saying, okay, we see that what the market price is right now, but we want to compare it to some benchmarks to see how far away is the market price deviating from certain historical benchmarks, right? So we have to create those benchmarks. Similar to if you were out there, shopping for a home, you would look at average sales, or what does it cost to build a new house, or what is the rent to buy ratio. So you would look at these benchmarks to see how far away you are. So the two that we put up here in the summary is, one, we say, well, what's the average end value of this put spread? So if we did a similar put spread historically, right, that we lined it up where it's out of the money, by the same percentage away as it is now, right? Because this is an out of the money put spread. It's out of the money the same percentage away as it is now. And we looked at the stock behavior, over time, many times for that same amount of time to expiration. Sometimes it would be worthless, sometimes it would be worth $25, sometimes somewhere in the middle. But if we did that, and this is set to 4 years of data, and you could change that, but if we did that, on average, what's the average end value, right? And that's what this is. That's the average end value. It doesn't mean every time, it means that's the average, right? So from that perspective, we see that the 198 is above that, right? So that's one thing to keep in mind. By $1.56. What if we took, though, and looked at it from another benchmark, right? So there's not only one benchmark, we could look at it from a couple different ones. And this is looking at just the historical implied volatility of similar options. So it doesn't look at the stock behavior. It says, okay, we did that separately. Let's look at just what the implied volatilities are typically for these types of options, and how are they related, simultaneously, because we want to see, simultaneous snapshots historically of how these two options, because there's a skew between these two. So we're capturing that and saying, if we looked at that data on average, right, how's this spread typically priced? And that's this $2.32. So this one is saying that $1.98 would look like cheaper, right, below the benchmark. So one above, one below. So we got these two numbers now to consider, in front of us. So the question is, well, what is, the win rate, right? So the question is, well, if this is the average, right? If this is the average 42, well, out of our observations, how many times, right, did it actually go above 198? Because this spread could be worth $25, could be worth $10, $5. How many times did it actually end up going above 198? Right? That's kind of, the win rate, the question. So let's go over here under summary, and we're going to look at this one, stock distribution first. So I'm going to click on that. So here it is, right? So this is just repeating the price we're trying to evaluate is $1.98. Historically, the average price of this spread, the data is down here below, it's 42 cents, right? So that's if we took that as the long-term break-even number, if that's what we used, then the average theoretical edge is negative 156. And how often did it go above $1.98. So we see from our 4 years of data that's set here, we see only 4 times. Okay, so you could see that so far from our data set, and this is using, by the way, the current implied volatility levels. All right, so we're looking at, we take the current implied volatilities of the 30-day IV, and then we look at the closest 1/3 of the observations, 33% of the closest observations. So from here, we see that the highest value was $10.14. Right, 100% of the values are below 10.14, 75% are below 0. So most of the time, this goes out worthless. Which, look, QQQ, it's been on a, if we look at it, it's because it's been trending higher too for 4 years. But let's expand that. Let's go to all implied volatility levels. I'm just out of curiosity. All right, so if I expand it, 4 years of data, it doesn't matter where the implied was, low, high, medium. Let's just look at all the observations. So this is, there are 50 observations here. All right, these are, it's over a 20-day period. So here, definitely the high levels, $25. It did hit that. Here, this is the distribution of them. So it looks like, it hit it once, 2% of the observations. We see one was around like $22 and so forth. So 12% in the last 4 years, 12% of the historical observations of looking at QQQ over a 20-day period, all right, did it go down enough, from the, from start date to end date in 20 days? At the end of 20 days, did it go down far enough by the end of that 20 days to cover the cost of this spread currently, $1.98? That happened 12% of the time. Okay. This is actually also, I'm changing, just so you guys know, this is a default view if we don't detect the strategy, but I think right now what we're working on, it's going to look a little bit different once we detect, basically identify the strategy that was inputted. It's going to have, and you're going to probably see next week potentially the changes, but it's going to have analytics and summary stats that's specific to that type of strategy. So like a call spread is a different type of strategy than like a straddle, right? You're looking at a different outlook, and so there are going to be differences in that. Right now it's all across the board the same, it looks the same, but there will be differences later on that will be more specific to a strategy that was entered, once, if we detect it, right? So I mean, if you put in like, some crazy strategy, then it's going to default to this view, with 5-6 legs going everywhere. But if we detect like okay, we understand, this is a straddle, or this is a strangle, or this is a risk reversal, then it'll have certain statistics that's specific, to that type of strategy. So let's go now to the other view. Now, that was based on historical stock prices. What about the implied volatilities? All right, so let's take a look at that, the IV Thea. And here, what this is showing us is the distribution of this spread, not the end value, right? This is looking at what is it typically priced at this stage, right? At this state before expiration, right? So that's what this is. So 20 days to go. What is the actual spread typically priced? Now where does it usually end up based on stock prices? But what is it typically priced at this stage, right? And it's using the historical implied vols. This is also using the dynamic, by the way. We could do all. So I'm going to do all for the last 4 years. So it's going to the last 4 years of data, and it's looking at, it's looking at our benchmarks. So it's creating benchmarks of what, if it doesn't find exactly this, because it'll be hard to find exactly the days to expiration every day and those strikes. So it's interpolating it. The machine is doing it, saying this is where the options would be priced based on weighted averages. And looking at that, what it's saying is that on average, this spread is typically priced around $3.36. All right. If we looked at our observations, the top one, 100% of them are below $9.52. So that's the highest that's priced, right? If we go here, over here, 952, March 220. 25% were below 221. 50%, that's the median, 334, 75 percentile, 429. So what about this 198? Well, since we're looking at it from a debit side, right, from buying it, we want to know, well, how many of the historical observations were priced above 198, right? How many of those? Well, that's 83%, 83% of the time. So from the historical perspective of where the implied vols are, or how these options are usually priced, because downside is always priced with a skew. So this does not look that expensive, because we could see here that here's the red line. That's where we are now. And these are all the ones priced higher. So you could see that 83% of the time, these options, typically this spread would have been priced higher in the market. Okay, so that was we're right up at 9:30, Will. So I think I'm going to let it go here.
Yeah, that was very helpful. Rob is very thankful that you showed him how to view that. Everyone loves this new report. That's great.
Okay. Awesome.
So we do have a new podcast out there on the IBKR website. I will post that in the chat as well. Jeff sent that over yesterday. Great job, D. You have a good trading day and a good weekend, buddy.
All right. Thanks, everyone. Stay safe out there. Have a great weekend, and have a great trading day. And I